Hi, this is Matthew Cratter from Trader University, and today I want to show you how to use covered calls to generate income in 2020. If you're interested in learning investment strategies or trading strategies to make money both in a bear market and in a bull market, be sure to hit that subscribe button. So one of the questions I'm always getting from my subscribers is how to generate income in these very low interest rate times. So if you're storing your money in a savings account, you're really lucky if you're making 1 or 1.3%. These are some high yield savings accounts. And so I'm going to show you a way of using covered calls as sort of a substitute for this. Now, obviously, none of this is an investment recommendation. Stocks can go down. They're more risky than savings accounts, but I'm going to show you a fairly conservative way. It's considered the most conservative options trading strategy. If you don't know anything about call options, be sure to watch my video from a couple days ago. I'm going to link to it in the description notes below. And that will make, if you watch that first, this will make a lot more sense. So we're going to look at Pfizer. It's a blue chip stock. It's been around forever. And when I'm writing covered calls on a stock, I like to find stocks that pay a decent dividend yield. In case the stock falls a lot after I write the covered calls, I want to be able to at least collect a dividend going forward. So Pfizer is a good candidate for this. Currently has a 4% dividend yield, and I believe the dividend yield is fairly safe. In this environment, you want to look for dividend yields anywhere between 2 and maybe 4.5%. You definitely don't want to go for the really high yield stocks. They can be a little bit more dangerous in this environment. So Pfizer's a good candidate, currently trading at 37.69. And so if you just click right here where it says options, that will take us to the options pricing page on Yahoo Finance. Now, when I am writing covered calls, I usually like to go about 45 to 60 days out. I find that is the sweet spot. So if you see here, this is the drop-down menu here for the different expirations. And again, if you don't know what an option expiration is, be sure to watch that previous video, which I've linked below. So we're going to go about a little less than 60 days out. We'll do the July 17th. Usually the third week of the month has the most open interest and the most volume. It's the most liquid contract. So we can see here, these are all the calls. As we said, the stock is currently 37.69, 37.70. And Yahoo does a good job of showing you which calls are out at the money and out of the money. So all these calls in this blue shaded area are currently in the money. And so when we write covered calls in a stock, we want to do them right at the money, right where the stock is currently trading, or slightly out of the money. So the strike price that's the first strike price that's just above the current stock price. So current stock price, 37.67, we would be selling the 38 calls. So if we click right here, this will give us the pricing. We can see that they're currently bid at $1.17, offered at $1.22. These are the 38 calls on Pfizer expiring July 17th, 2020. Now, so I've already done a little work on this. We're going to use slightly different numbers because they changed since I did it. But basically, this is how you do covered calls. You buy the stock right where it's trading right now. So you use a limit order, or you can even use a market order if it's a very liquid stock like Pfizer. So we're going to buy 100 shares roughly where it's trading right now. It's traded up a little bit since I made this diagram. But you basically buy the shares where they're trading. So we'll buy 100 shares of Pfizer at 37.62. That will cost us $3,762. If you're using a broker like Robinhood, you don't pay any commissions, and that's why I'm not using any commissions in this example. If you use a broker that still charges commissions to trade stock or options, that will obviously be some expenses that will slightly lower your profits here. But either way, it shouldn't make too much of a difference. So we buy 100 shares of the stock right where it's trading, and then we sell the next call up, the next strike price up. That's about 45 to 60 days out. As we said, we're going to be looking at the July. So for every 100 shares that you buy, you sell one call. One call is the equivalent of 100 shares. So you have to do these in equal amounts if you want to do a traditional covered call. So we pay $3,762 for 100 shares of the stock. We immediately sell, and this is a sell to open. You'll probably see you can have different choices. Sell to open gets you into a position. It's a little weird when you first get started with this because you're selling something you don't own, but this is basically just how it works. You're selling to enter into a position. And the nice thing about selling is you get to collect some money called the premium. So we'll be selling one call at $1.15, The multiplier for options is always 100. So if you see a $1.15 and you're selling one call option, you just multiply that by 100. That tells you how much money you'll be collecting from this trade. So we'll be collecting $115. We buy the stock, we sell a call against it. Now, if we look at these, sort of the return on investment of this trade or this investment, it's looking quite good actually, because so we'll basically take the premium we collect, which is $115, and we divide it by the capital that we deploy, $3,762. So you divide these two, and you get about 3%, which is for a holding period of 2 months is quite good. As we saw, you can hold your money in a savings account, and you only make about 1.3% per year. Here we're already making 3% for 2 months. Now, if you can do this every 2 months for a year, do it 6 times a year, you can make 18%. In practice, you won't be able to make quite this much because the stock will bounce around. But if you get really lucky and you can do it, the stock sort of stays where it is and volatility stays where it is, you can make about 18% on this trade, doing it every 2 months for a year. So what happens? What are the different, what's the sort of scenario analysis look like for this trade? Well, if the stock is below 38 when this option expires in July of 2020, we get to keep the stock. We still own 100 shares of Pfizer. We get to keep the premium that we collected, the $115. The call option that we're short, that we've sold to open, expires worthless. And we're basically done with the trade. We've made 3%, assuming the stock hasn't fallen a lot. Maybe we can just get out at the same price we paid, or roughly the same price. And so we made 3% over 2 months. Now, at this point, what you can do is you can just hold the stock. As we saw before, it trades for about a 4% dividend yield. So if you hold the stock for another year and they keep their dividend, which they should, you'll make another 4% on top of this 3%. So you'll be making about 7% in 12 months. You can also, if we're still below the 38 strike price, you can sell another 38 call it 45 to 60 days out. So when this expires in July, maybe you would go forward and sell the September, even the October. You can sometimes go 90 days out if you want, and you can collect a little bit more premium in exchange for a little bit more risk because you'll be holding the stock for longer. So that's what happens if Pfizer is below the strike price of the call at expiration. You keep the stock, you keep the cash that you made, you keep the premium you collected. The call option expires worthless, it disappears from your account, and you're just a stockholder in Pfizer. You can sell another call, or you can just sit there and collect the dividend. Now let's say Pfizer has rallied a little bit by July, by expiration. If Pfizer is trading above 38 when this option expires, you still get to keep the $115, but the stock will be called away from you. This is why they're called call options. The stock will be taken away from you. It will be sold at $38. And so you will get to make the difference between the price you paid, $37.62, and the price it was sold for, $38. So that is 0.38 on the stock. You own 100 shares, so that's an extra $38 that you pocket from this trade. And so when you combine that with the $115 that you made by selling the call, you've collected $153 over this holding period, which is better than 4% in 2 months. So again, if you can do this, if you could do the same thing 6 times a year, do it every 2 months, you'd be making about 24% in your money, which would be obviously amazing. In practice, it'll be less than that, but these things are possible. Now, what happens if the stock falls a lot? So let's say we buy it at $37.62, and instead of rising or staying the same, let's say it falls down to $35. Well, in that case, we still get to keep the $115 that we collected. The stock is below 38, so it won't be taken away from us. It won't be called away from us. We'll get to keep the $115 premium. And now what we can do is because we picked a good stock, we're confident in Pfizer. Again, I'm just using this as an example. But if you think they're going to continue to do well, or at least stay as good as they are now, you can just hold the stock and you'll still be making a 4% dividend yield. And so you'll still be really beating money in a savings account, albeit taking a little bit more risk. So you can just hold on, collect those quarterly dividend payments, those dividend payments that come every 3 months. And then you can sell it when it gets back up to $37.62, the price you paid for the stock. Or if you want, as it gets close there, maybe when it gets back to 37 or 37.20, somewhere around there, you can sell another 38 call 45, 60, 90 days out and collect more premium. And so this is a way, it's a very, very satisfying sort of trade. You get to keep milking the stock and pulling out these premiums. And you can see that if you continue to do this, it will essentially lower your cost basis. So that's another way of thinking about it, that every time you sell a call for, call it $1, it lowers your cost basis by $1. So if you do this 30 some times, 35 times, 36 times, you will basically have a cost-free position in Pfizer because you will have monetized it. You will have collected all this premium over time. So those are the three scenarios. The stock's above 38, in which case the stock gets called away from you. If it's below 38, you keep the stock. You can collect the dividend and maybe sell another call. The one scenario where you do badly is if Pfizer starts to do really badly. Obviously, the stock could go to zero or it could go down a lot, in which case, at least you're still collecting the dividend. Worst case scenario, they cut the dividend and you're stuck with a loss. Now, why is this not as bad as just holding the stock? Well, if we just bought Pfizer and it did badly, we would stand to lose $37, the full amount, $3,762. But because we sold a call up front, we're sort of cushioning our downside. And the more calls that you can sell over time, the more you cushion this downside. So in this sense, covered calls are actually safer than holding the underlying stock and not doing covered calls on it. Because if you hold just the outright stock and it falls, you can lose this amount. But if you've collected $115 first, you can only lose $3,762 minus $115. So that's something to keep in mind. This is one example of an option strategy where it's actually safer than holding the underlying stock. Now, you are giving away the upside. So if you think Pfizer is going to 50, you definitely don't want to sell a 38 call and have it called away from you at 38, and then you watch it go to 50. So you want to do this on stocks that you don't expect to go up a huge amount, but maybe expect them to trade in a range, sort of chop around in a range. Now, if you're doing this trade on Robinhood, I can show you how to do it. Basically, you type in the ticker, PFE up here. You enter a limit price. The stock's currently at $37.67, so I'll just use a limit price, maybe slightly above that, $37.70. I'm going to buy 100 shares. I click review the order, and I buy the stock. Now, immediately after buying it, I want to sell a call. So what I will do is I have to click down here where it says Trade PFE Options. After I buy 100 shares of the stock, that will take me to this options page, and they have a really nice interface. I like this. It's quite intuitive. So I'm going to be selling a call because I'm doing covered calls. I'm going to pick the July 17th expiration, as we said. And I like how they do this. You can see the share price is right here, $37.69. And so you'll always want to sell the call that's right there. If there was a $37.69 call, I would do it. Or you just go up a strike price. So as we said, we'll sell the 38 call right here. The numbers have moved around a little bit since I did my example. But basically what we'll do is we'll just click the plus button here. It says short call. And we can use basically just continue, and in this case we'll, instead of collecting a $1.15, we'll collect a $1.24 by selling this call, because the stock has rallied a little bit, and so the calls are have increased a little bit in value. But that's the two-step process. You buy 100 shares of the stock, you sell a call at a strike price that's right above the price you paid for the stock. So Pfizer is a great one to do this on. There are two others I wanted to give you. One is a slightly higher price stock, depending on how much capital you have, because when you do covered calls, you always have to buy at least 100 shares per one call option. So in this case, it would cost, call it $18,000, $19,000. McDonald's, good long-term prospects, and they pay, their dividend's not quite as high as Pfizer. It's probably more of a growth stock than Pfizer. And but they still pay a good 2.71% dividend yield, which beats any savings account. And so we would do something similar. We would buy the stock at $189.26, and then we would go maybe the same, go back out to the same expiration, and we would sell the next call up, which is the 190 calls. We can see here that we would be collecting 590. So let's see what that is. 590 divided by the price we pay for the stock, 189.24. So it's about 3.1%. It's fairly similar. So that's something you could do on McDonald's. You could do it on Pfizer. Starbucks is another fairly conservative one that Starbucks isn't going anywhere soon. They currently pay, ticker is SBUX. They currently pay a dividend yield of just over 2%. So not as good as McDonald's or Pfizer, but still a decent dividend yield. And then we do something very similar. So we buy the stock at $78.98. We click here and look at the options, and we go 30, 60 days out. We'll go to the July 17th, and we will be selling the next strike price up, which are the 80s. So we can currently sell them for about $320 and collect, for one call option, collect $320. That's how call options work. If you want to go a little bit more in depth, I have a whole course that covers how to make money with covered calls, and there's a lot of different things you can do with them, including poor man's covered calls. I have an extensive lecture on here that really goes into that. If you're currently in quarantine and you're tired of watching Netflix, binging on Netflix, check out this course. Check out all my courses. The good news is membership in Trader University gets you unlimited access to all 13 courses, including the covered calls course, Learn to Trade Stocks Like a Pro. I have a couple other options trading courses that go into depth with all the different options trading strategies, bear market trading strategies, crypto and Bitcoin, futures as well, financial statement analysis. So really, whether you're interested in technical trading or fundamental investments, fundamental analysis, I've got you covered. Now, normally 30 days access, also real estate course, 30 days access is just $125. Gets you access to all the courses. You can watch them all. But I want to give you a coupon because we're in a recession. So click in the description notes below. It will take you to this page where you can click on any of these boxes and see all the lectures. And then if this is something that interests you and you'd like to try it out, you just click Get It Now. That'll take you to the checkout page right here. And as I said, I have a coupon code I want to give you. So you click right here where it says Have a Coupon Code. Type in YT, as in YouTube, 99. Click Update, and that'll take $26 off the 30-day price. So you just paid $99. You get access to all the courses, including the covered calls course. You can watch them all, take notes, cancel before 30 days is up, and you won't be charged again. There are no long-term contracts or anything like that. And if there's a course missing or a lecture missing or a trading strategy missing that you'd like me to cover, you can just let me know as a subscriber, as a member of Trader University Premium, and I will make a course just for you on whatever you're interested in that's not already covered. And then I'll share it obviously with all the other subscribers. And in this way, I hope to really improve this and make Trader University the best resource on the internet for learning how to trade and learning how to invest, whether you're interested in stocks, options, futures, crypto, value investing, momentum stocks, whatever it is, I've got you covered. Thanks a lot for listening. Hit that subscribe and like button if you found this useful. And let me know your questions and comments in the comment section below. Thanks a lot for listening. Hope you guys are all staying well, and I'll see you in the next video.